If you're serious about trading, you've definitely heard the name Al Brooks. His books, they're legendary, often called the Trader's Bible. But let's be honest, they are also incredibly dense. So today, we're going to decode the core genius of his price action methodology into a clear, actionable explainer. Okay, let's dive right in. First up, does this look familiar? I mean, a screen just plastered with so many lines, oscillators, and indicators that you can barely even see the actual price buried underneath. It's such a common trap, and it almost always leads to more confusion than clarity. And that right there is the core problem we're tackling today. You see, in trading, complexity is very often the enemy of profit. In a world of high-speed computers, our first impulse is to add more and more information. But what if the secret to consistency isn't adding more, but actually taking things away? This leads us to a huge issue for modern traders, the sheer chaos of overanalysis. It's a condition a lot of people call analysis paralysis, and trust me, it can be absolutely devastating for your trading account. Here's the dilemma in action. You've got multiple indicators going, maybe an RSI, a MACD, and some Bollinger Bands, and they're all screaming different signals at you. One says buy, the other says sell. And what's the result? You hesitate, you freeze, you end up missing the move, or you get in way too late, which just kills your profitability before the trade even gets going. So what's the alternative to all that chaos? Well, it's something elegant, powerful, and it's been around forever. Price action. It's all about learning to read the market's universal language directly from a nice, clean chart. Now, this quote really gets to the heart of it. Think about it. Indicators are just math formulas based on past prices, so by definition, they're always a step behind. Price action, on the other hand, is the real-time record of the battle between buyers and sellers. It is the truth of the market. And this just illustrates the difference perfectly. The old way relies on indicators, which means you're always reacting to something that has already happened. Price action lets you read the chart in real time, giving you clarity and the ability to anticipate what's likely to happen next. So, what is it exactly? Well, at its core, price action is the skill of reading human behavior right on a chart. Every single one of those candles tells a little story, a story of fear, greed, and hesitation. And when you learn to read these stories, you can trade any market on any time frame because human psychology is universal. Okay, theory is great, but how do we actually apply this? We've gone ahead and distilled Albrook's massive body of work into 3 fundamental principles that you can start looking for today. The first and most important principle is to treat the trend like gravity. I mean it. You can try to fight it for a little while, but eventually it is going to pull you down. Trading with it is always the path of least resistance. Brooks came up with a brutally simple rule for this called the always-in mindset. It uses just one indicator, a 20-period exponential moving average. And the rule is simple. If the price is above a rising EMA, you are always in long and should only be looking for buys. If it's below a falling EMA, you're always in short. That's it. This simple filter alone can eliminate over 2/3 of your bad trades. All right, let's move on to the second principle, which is hands down one of the highest probability setups in all of trading. It's called the two-legged pullback. And I promise you, once you see it, you will start seeing it everywhere. Here's the key insight. After a strong move, the market very rarely pulls back in a nice straight line. It almost always corrects in 2 distinct ways, or legs. The end of that second leg is often a fantastic, low-risk entry point to get back into the trend. So here's what that looks like. You've got your strong initial trend move. Then you get the first pullback against it. After a little bounce, you get a second push down. That second leg, that area right there, forms the golden entry zone for the next major move up. The third principle is a little counterintuitive, but it's incredibly powerful. It's all about profiting from other traders' mistakes by exploiting what's known as a failed breakout, or simply the trap. So here's how it works. Price breaks above a key high, and every amateur breakout trader jumps in, going long. But then bam, it slams right back down, trapping every single one of them. Fading that move, which just means you trade in the opposite direction, is a classic institutional play. You're trading with the smart money that engineered the trap. Now, let's put it all together. Knowing the principles is one thing, actually applying them is another. So here is a simple, repeatable 5-step framework you can use to turn all this theory into action. It all starts with context. Step 1, is the market trending or is it just ranging sideways? Step 2, read the candles.
Who is in control right now, the bulls or the bears? Step 3. You gotta obey the always in rule. Trade with the trend. Step 4. Be patient. You have to wait for a high probability setup like a two-legged pullback or a failed breakout. And finally, step 5. Manage the trade, using logical price targets, not emotion.
But here's the final lesson, and it might just be the most important one of all. The real edge in trading isn't just some pattern on a chart. It's what's going on between your ears. Take a good look at this number, 80%. What do you think this represents in the market? Well, Al Brooks's research shows that markets are in a sideways trading range about 80% of the time. This is where most traders get absolutely chopped up, overtrading and chasing tiny little moves. Just recognizing this context is critical to preserving your capital. And this leads to the ultimate mental shift that every successful trader has to make. You have to stop looking for certainty. As this slide says, there are no sure things. The goal isn't to be right all the time. It's to consistently put the probabilities in your favor.
So, what's the real takeaway here? The Holy Grail isn't some secret indicator or a magic pattern. It's a mindset. It's the discipline to think in probabilities, to manage risk, and to execute your plan, even when you're facing total uncertainty.
So we'll leave you with this one question. After clearing off your charts and focusing on price, are you truly listening to the story the market is telling you, bar by bar? Or are you still getting distracted by all the noise? The answer to that question could change everything.